Hey guys, today we're taking a look at stocks versus bonds and what the main differences are, because everyone should understand how bonds and stocks are related and how the price of bonds can change the price of stocks and vice versa. So without wasting any more time, let's get right to it. Hey guys, my name is and thanks for visiting my page. And if you're new to the channel and want to grow your investing knowledge, then I recommend you hit that subscribe button. So now first let's take a look at what stocks and bonds are and what they're used for before we dive deeper into each one. So companies like Apple and Amazon, or any company for example, they need money to fund their operations and grow. So when they need money, they're able to get this by two things. They can either finance through equity, which is stock, or they can finance through debt, which are bonds. Financing through equity means that they're able to sell shares of their company to the public like us for money. And when we buy these shares, we can say that we own Apple stock, which means that we own a piece of the company. And this may be a very, very small piece of the company, but we still own something. So in return, we own a piece of the company and we pay money to Apple for that, and they don't have to pay us back. But we are the shareholders of that company. So if the value increases, for example, our share of the company would also increase, or I guess in other terms, our stock price would increase. And if the company decides to pay dividends to its shareholders, that means we would also receive these dividend payments. And if the company gets sold for an X amount of money, we would also get a piece of that money because we are owners of that company. But if the company does go bankrupt, well, we will also go bankrupt. So now that we know what financing through equity means, let's take a look at financing through debt. And this means that the companies would have to pay us back. So companies could either go to the bank and get some loans, which is debt, or they can issue bonds. And in simple terms, a bond is a loan from an investor to a borrower, such as a company or the government. And the borrower uses this money to fund its operations, and in return, the company agrees to pay us back a value on a specified date and interest payments along the way. So depending on which type of bond it is, let's assume it's a regular 2% coupon bond payable in 5 years. So that coupon part just tells you the annual interest payment that the bondholder receives. So for example, let's say the face value of a bond is $1,000. So you would receive 20% of interest each year by holding this, and at the end of the specified period, the company would pay you back that $1,000 as long as they don't go bankrupt. So generally, bonds are safer than stocks because you do have that guaranteed income coming in through the interest payments. And also, you're able to hold the bond till maturity and get all of your principal back. And lastly, you can also sell the bond at a profit. However, there are a few disadvantages to holding bonds. So one, the bonds generally do pay out lower returns than the stocks, and companies can also default and not pay you anything. And lastly, these bond yields can change depending on the interest rates. I hope you guys enjoyed this video and a simple comparison between bonds and stocks. I will be talking about how bonds and stocks work with interest rates, and if you guys want to see that, then definitely come check out my next video. Until then, I'll see you guys next time.